Hi, my name is Jordan Wilson. Today we continue our look at mutual funds with a focus on performance considerations. Our objectives are to look at the absolute return, the standalone return of a fund. We'll look at some of the common return measures, and hopefully we'll see how the presentation of a specific measure can lead to different investment decisions. Then we'll look at performance on a relative basis, how we need to contextualize returns, create the apples to apples, not the apples to oranges assessments. The first area we want to focus on are the absolute returns of your mutual fund. And we looked at this in our discussion in a previous episode on investment returns. And it's very similar, but a bit different. The first one is you need to fixate on net returns, not gross. And this is especially important in funds because we see that from our last episode that mutual fund expenses can be quite substantial. We saw the RBC example where a low-level investor was paying 1.89% per annum on the fund. A do-it-yourself investor was paying 1.05% each year on that fund. So over time, that's a lot more significant than your transaction costs when you buy or sell an individual stock. So we need to focus on what was the money in your jeans at the end of the day, the money that will be used to compound, and that's what really grows your portfolio over time. So you need to make sure that when you're looking at returns, it's on a net basis and it backs out the fund expenses, which, as we saw last time, tend to be management fees, which are the bulk, back office administration costs, marketing costs, trading costs. So just when you're looking at fund performance, make sure you're seeing net returns, not gross. Second, we want to focus more on annualized, not cumulative returns. And what you'll often see in performance in fund data is, okay, if I invest $1,000 10 years ago, this is what it grew to, or you'll see that the fund returned 187% over 5 years on a cumulative basis. But I'm not sure that tells you a whole lot. It doesn't talk about the performance on a year-to-year basis. So again, apples to apples. You want to look at annualized performance so they can compare different periods a little bit better. Now the problem here is I have two examples. Year one, the current year, the fund returned 27%. Over 3 years on an annualized basis, 12%. Over 5 years, 8%. And over 10 years, 3%. Now, I'm not quite sure what this tells me because it could tell me a variety of things. It could tell me that maybe I fired the managers that were there for the first 5 years that had relatively poor performance. And when I say relative, based on their historic data. And now I've got new managers who this year alone have bumped my returns up, and that may continue on into the future. Maybe I just got lucky this year. I managed to pick 3 of the best investments on the planet. I bought Bitcoin, I bought Tesla, and that's why my performance was incredibly high. Maybe there was a recession 7 to 10 years out that destroyed performance. So I need to look a little bit more at things. And we kind of see that in the next one as well. Minus 12% in the previous year, 6% in the 3 years, 14% in the 5 years, 18% in the 10 years. Is that negative 12% this year an anomaly? Did the fund managers who were highly successful quit and suddenly it's a rudderless ship? So again, the data is there, but you have to dig a fair bit deeper to figure out what the rationale is for these things. The other area is that you want to focus on total return, not just the change in the net asset value of the mutual fund. Because again, we want to look at money in our genes, and the total return does reflect the change in net asset value. But it also includes any income, any capital distributions that are made from the fund to the shareholders. So if I have a fund that has 10 units and its NAV is $100, and I distribute 50 of those dollars to the shareholders as dividends or capital distributions, suddenly I've still got the 10 shareholders, but only $50 in NAV. Is my fund actually worth half of what it was before I paid out that dividend or distribution? No. So again, as an investor, you need to make sure that you're not just looking at the change in the price, you're factoring in distributions and those sort of things. Another issue that we need to consider is that returns are all relative. Your performance is a relative concept. Now, when we get fund data, it's usually presented in, here are our returns on a monthly basis for this year, year to date, maybe 1, 3, 5, 10 years of annualized returns. And often they're presented since inception. So if a fund has been around since 1982, you're going to see its annualized performance since it began operating. Now, don't be mesmerized by year-to-date or one-year returns. The longer the assessment period, probably the better the analysis that is possible. And I say probable because circumstances can change within a specific company. Now, in the short term, luck can play a big role in current year results. There could also be management shenanigans, and we'll look at some of the possible shenanigans in a future episode. So in the short term, luck or trickery can impact your short-term results. It's much harder to maintain that over a 10-year period. And of course, luck or manipulation can go both ways. You can have some bad luck. Maybe you made one mistake over 10 years, but that's coming through in this year's results, and you look like an idiot. Should you be judged by one mistake over 10 years? So the longer the time period that you have for the return data, the better for analyses. And if we look at this concept, let's say that we had a fund, ABC. It had returns of 12% for 1 year, 10% annually over 3 years, 11% annually over 5 years. And it's investing in Canadian small cap equities. So one thing the history does tell us a bit here is that 12 for 1 year, 10 for 3, 11 for 5. It's been fairly consistent as far as its results go. And maybe that gives us a little bit of comfort that its future performance will also sort of stay within that range. We may not expect to wake up next year and see minus 30% or plus 50%. So history does give us a little bit of comfort. Not as much as we'd like, but a little bit. And history actually tells us where to investigate, because if there is a variance, why is there the variance in returns? Is it luck? Is it trickery? Is it a change in fund management? And in our example here, if ABC suddenly returned 45% in the current year, but was still at 10% over 3 and 11% over 5, then that's an issue that could be happening. Maybe the prior year performances were poor and they got rid of the previous fund managers, and the new team that came in was able to generate a big bump in return. Maybe it was luck. Maybe it was management trickery, smoke and mirrors that got us this accelerated return. So it's an issue that you have to investigate, because there's no guarantee based on prior results that 45% will continue in the future. The other thing you got to play into your analysis is that 45% in the current year, that's also part of your 3 and 5 year performance. So in our first scenario with ABC of 12% in the current year, 10% in 3, 11% in 5, you know that over the 5 years, your performance was fairly consistent. But suddenly you throw in a 45% return in the current year, and that's greatly skewed, that 10% and 11% for the 3 and 5 years. Without that 45%, you're going to have annual returns that are probably half or less that rate. So again, wild swings in a specific time period can skew overall returns over time a bit. And then again, the last thing is past performance, no guarantee of future. It may give you some hints, but it's not necessarily a given. And that's why pretty much every mutual fund prospectus that you will ever read has some form of that statement within it. Past performance is no guarantee of future results. May provide clues, but not guarantees. Another way to look at standalone returns is on a risk-adjusted basis. So you're comparing it to other risky assets. One of the ways to compare, though, is basically zero return. You obviously, regardless of the world, you want a positive return on your portfolio. Now, for some people, zero return might be nominal. Anything that you get over zero is a positive return. Others may say, we need to maintain our purchasing power. So anything that's above the rate of inflation gives us a real return. So that will be our benchmark for zero, is the inflation rate. Others might say, yeah, but we're assuming some investment risk by investing in this mutual fund. I demand a risk premium for that. So for me, my zero return is the US or Canadian T-bill rate, because that's considered a risk-free asset. So depending on who you are, your idea of sort of a risk-adjusted return comparison might be slightly different. And it does give you an idea when you look at the return of your fund, what that risk premium is. Now the question is that a good risk premium or not? And for that, people tend to use risk return ratios to sort of get an idea of what the efficiency of their risk return is. How efficient am I generating return for a given level of risk? And that might be a Sharpe, Trainer, Sortino ratio. And they've got their good and their bad points, but again, it's another tool in the toolbox to help assess your performance. But it's one thing to sort of look at what's the rate of inflation or what's the risk-free rate. You need to really compare your returns on a relative basis to similar risk assets. If I have a standard deviation of 20, which let's say it's relatively risky, what does it accomplish for me to compare my fund performance against the risk-free rate? It really doesn't. So we need to look at things on an apples-to-apples basis again. And that's kind of looking at your peers, looking at your risk-return groupings. And if you're a mutual fund, that might be sector or category. And that could include, maybe I'm categorized by my market capitalization that I invest in as a fund. So you see funds out there that invest in small cap, and that was my example of ABC, a small cap Canadian equity fund. Maybe I want to be categorized as Canadian equity. Equity itself is a category. So again, you want to look at what sector. Is it precious metals? Is it mining? Is it consumer staples? Is it consumer discretionary? Is it energy? What sector am I in as a fund? And how do I compare against like-minded funds who invest in similar assets? So again, you're going to find that. You'll also, it's usually not that hard, because when you look at a fund, especially if you review on, say, Morningstar, it will tell you what category it's in for their purposes of analysis. And again, when you want to look at your fund's ranking, that could be, if you use Morningstar, their 5-star rating system. If you're in the top percentile for performance, over time, you're a 5-star. If you're in the bottom, sort of 1, maybe even 0. The only problem with companies like Morningstar is that they need to build up a bit of history before you can attribute stars. So if I'm a brand new fund and I've only been around for 2 years, it doesn't matter how good or how bad my performance is, I won't be attributed a rating yet. You also see funds ranked by quartile. Am I in the top 25% of all funds in my category? Or I'm Am I in the bottom 25%? And that kind of helps you rank where your fund is or where your potential investment is versus its peers. And even then, I'd probably drill down a little bit into key competitors. We looked at the RBC Canadian Equity Fund in the last episode. Canadian equities, $2 billion fund, quite high asset volume, probably not as nimble or agile for stock picking as a $100 million fund. So are they truly comparable? Maybe not. So I want to look for other funds that are in that over $1 billion category for assets under instrument and compare them. So I don't penalize RBC for not being able to invest in micro or nano or even some small cap companies. Their managers shouldn't be penalized for just having a huge fund. If we go back to our ABC comparison, we said that their performance over 1 year was 12%, 10% for 3 years, and 11% for 5 years. But we didn't really know, like, what does that tell us? Is 12% a good return, a bad return? For them, it's a consistent return, but is that consistently good or consistently bad? So that's why we look at the peers. Perhaps the 5-year annual return for US large cap stocks averaged 9%. We'll say that's the S&P 500. So our fund over 5 years averaged 11%. This one, 9%. So that sounds good. But again, it's a bit of apples to oranges. The ABC fund invests in small cap Canadian equities, not US large cap stocks. Some general market comparisons, maybe. But again, it's apples to oranges. You want to drill down into something a little bit more comparable. And maybe I find that the average Canadian equity small cap mutual fund had a 5-year return of 8%. Now suddenly we're comparing apples to apples, and the ABC return of 11% looks great. So that's sort of things to get into, is again, apples to apples when you're reviewing. The next thing you want to look at are benchmarks. And that's something that when we do our policy statements, we want to define beforehand. And again, if you look at most mutual fund data on Morningstar or within the fund company fact sheets itself, it'll usually disclose what benchmark your fund is being compared to. But benchmarks can be anything. We talked about the zero nominal rate of return, the risk-free rate, the real rate. So those can be benchmarks. You can choose your own benchmark. There's over 3 million indices around the world in every asset class and every country around. And that's something that you should be doing anyways in your overall portfolio. So if I have a portfolio that's 25% US blended equities, 25% global equities, 25% fixed income, say American bonds of mixed durations, and then 25% in real estate, commodities, and maybe emerging or frontier market equities. I don't want to use the Dow Jones 30 as my benchmark. And that's what you see a lot of people doing, is it's okay, we'll just take something that's generic, like the S&P 500 or the Dow, which is on the news every day, and that's what we'll compare our performance to. Probably more useful to just find an index or multiple indexes for each of those individual asset subclasses, weight them based on your portfolio, and this is your target asset allocation up front, and then you compare your performance over time. So if we go back to our ABC Canadian Small Cap Equity Fund, probably don't want to use the S&P or the Dow for my benchmark, but there is a Morgan Stanley Canada Small Cap Index that tracks smaller capitalized Canadian companies. To me, that would be preferable to the S&P and even the TSX Composite Index in general, because Canadian is the TSX Composite, but it's weighted by market cap, so it has a large cap bias. Again, the better the comparability, the better the information that you get. So I think those are the keys to benchmarking. Find a benchmark that represents your portfolio or the mutual fund that you're investing in, and that will better help you assess its relative performance. And I think the one thing to remember too with the benchmarking is, and this applies to both active and index funds, which are relatively low cost, is that RBC fund had management expense ratios of 1.89, 1.05, depending on the type of investor you were. So they're starting the year 1 or 2% in a deficit. If they're being compared to the TSX 300, then they have to outperform the TSX by 1 or 2% to beat their benchmark. And that's the problem with mutual funds, is that if they have a relatively high MER, they need to significantly outperform. And as we saw with the RBC example, I think it was over 10 years that the TSX averaged 5.95%, and they're charging investors management fees of 1.89. That's a lot on a percentage basis of outperformance that they have to generate to beat the benchmark for their net returns. And you see that as well with index funds, even ones that are at 0.18 or 0.07 for MERs. You're still starting at a slight deficit. So very hard to beat your benchmark returns. That's it for today. A good look at some performance analysis considerations if you're investing in mutual funds. And we'll look a bit more at fund managers and some of the potential issues that you might see, and let's call them shenanigans in a fund. And that'll be next time. Thank you very much. Have yourself a good day.